Hello, everyone, and welcome to Starts at 60's second ever virtual event. We want to say a big welcome to you all, and we hope that you and your families are keeping well in this challenging time. If you're not familiar with Starts at 60, we're the home of the biggest community of over 60s in Australia. I'm Rebecca Wilson, your host, the founder and CEO of Starts at 60. We've been supporting, informing, and entertaining over 60s online for 7 years now, hard to believe. And nearly 1.4 million people join us every month on our website, startsat60.com, or our Facebook page, our Facebook groups, and through our email newsletters and community meetups. We're currently adapting our offerings to support over 60s during these difficult days, so expect to see more virtual events and new initiatives in the coming weeks. If you haven't signed up to Starts at 60 yet, please make sure you do so on our website so that we can give you a heads up about events and information you might find helpful right now on your money, your health, and just staying sane and having fun while you're stuck at home. I have to juggle the slides today, but that is where you can sign up, as you can see there. I want to thank our large community of over 60s. We're particularly conscious in Starts at 60 that there are special challenges older Australians are facing right now, and they're pretty unique because they may be at more risk of coronavirus than other age groups, and because they're often more reliant on a government payment, like the age pension, than other age groups are. And because it's harder to find and keep a job than other age groups, and because people have less time to allow their super to bounce back in these areas. So we're really, really conscious that that is why now more than ever we need to come together to support and learn from each other so that we can come out the other side united and strong for the next phase. We couldn't do this without the support of our sponsors, so we'd like to say a really big thank you to Westpac for sponsoring this event. Westpac does amazing work to support the mature market, and they're doing even more at this time to ensure that everybody has more information than they need to get through this. So we encourage you to check out their products and services and their help, which is so forthcoming at this time. Now, before I introduce today's panel and we kick things off, I want to let you know how the session will run. We're going to start with about 45 minutes of prepared questions from me, followed by 10 to 15 minutes of questions coming from our community. We have the chat function running, so you can engage with other viewers in the Zoom meeting, or if you're watching on Facebook right now, which we are broadcasting through Facebook Live as well, on Starts at 60 on Facebook, you can chat with the community. The only questions we'll be accepting for the Q&A session will be coming in through the Q&A capability. Otherwise, people will just be replying to you through the community in chat. We've received literally hundreds of questions already, so chances are somebody's submitted a question you're looking for an answer to, and we're going to try and get through as many as we can today. The team will be putting them live into my screen so I can make sure our panelists. So now that we're back on your screen, I'm going to introduce our panelists. Give us a wave. We've got Besa, Deda, the Chief Economist of St George Bank. We've got Rob Lockhart, the financial educator from Westpac's Davidson Institute. We've got Bryan Ashenden, the head of financial literacy at BT Super. So this panel has been assembled because we want to hear from people who can offer meaningful guidance on the major questions on what to do with your money right now. You've had a lot of questions that have been complex about investment, the pension, property and other topics, and we will be bringing a lot of those answers in more webinars over the coming weeks. But today, we're really going to get started and get straight to the topics everyone wants to discuss. So Bryan, you're up first. Yep. What do you think people who have their super invested in a balanced option will see when it comes to returns for the first quarter of this calendar year?
Okay, well, it's always an interesting one to start off with market returns. I think there's no doubt that if you just look at what's happened in the first quarter this year, that people are going to see a decline in their account balance. And that's probably irrespective of how you're invested, unless it's purely in cash. Because if you're in a balanced option or a growth option or wherever you are, you've probably got some money sitting in the share market, whether it's in Australia or whether it's overseas. And I think, as we've all seen on the news, the share market has come down a fair bit. It has been a bit volatile, but the question as to what sort of impact you would individually see would obviously depend on how your money's invested. Now, if we've seen, just as an example, let's say that we've seen the market come off by 30%. That doesn't mean that your super will have gone down by 30%, because if you say a balanced option might make you think it's 50% shares and 50% more in cash, then maybe it's only come down by 15%. But a balanced option also doesn't necessarily mean it's exactly 50%. So you have to look at your own super fund, how your money's invested. But there's no doubt it's probably come down a bit. It's just going to be a question of how much.
So has the horse bolted on changing your asset allocation?
A lot of people sort of say, is it now the right time to do it? Well, I guess if we knew what markets were going to do at any point in time, we could always have said we would have done it when it was at its peak. Has it bolted? Well, I think the issue you really have to think about is, why do you actually want to get out of the share market? Because yes, there has been some volatility, but we've also seen, it's been a couple of days this week where the market's actually gone up quite considerably. I think a few days ago it went up by 7%, its best return, single day return in about 30 years. So again, you need to be really careful. If you drop into cash too quickly, then you're going to miss out on the upside as the markets do start to rebound. You also have to think about that if you're going to move into cash, then you are selling assets. There might be some transaction costs when you do that, so that can further erode your balance. And you're crystallizing or bringing home that position that you've got on those assets. So if it has fallen, you're missing out on the ability to go back up again. So I think you always need to be really careful about it. So is it too late? It's not too late. You can do it. But the question really is that the right thing to do?
Yeah, very much. So Rob, I've got a question for you. We're assuming people who had a large part of their super balance invested in equities are going to be seeing considerable on paper losses right now. Should anyone in that situation immediately update the value of their super with Centrelink?
I'm going to say, with regard to Centrelink, yeah, whenever Centrelink basically says if you've got a change in the asset values of $1,000, you should update your Centrelink asset values. Having said that, generally with a share portfolio, you will have put in the number of shares you have in what companies into Centrelink, and they update that twice a year in March. So they've actually just gone through an update of that. So they've probably got right near the bottom of where we are at the moment. And they'll do another one in September. But I think it's always a good idea to get onto your MyGov account and into your Centrelink account, check what your assets are with Centrelink right now. If they haven't changed them, or some of the other ones, which your bank balances, other assets, update them now. I believe there is a way that you can say, I'd like you to, update my assets to try and to force that through. But I must admit, I'm not an expert fully on that, so I'm not quite sure how to go about doing that. But I'd say get onto your Centrelink, check what's on there, and update it as much as you can.
Great, and we'll be having Centrelink on for some interviews and some articles on Starts at 60 in the next week, so that we'll have all that information for everybody from the horse's mouth, which is important. But we've got loads and loads of questions on super, so I'm going to roll back to Bryan quickly. And people who did move their money into cash, now what? Do they just sit tight, wait for the market to recover? Or do you have thoughts on how long that might take? What happens here?
Yeah. So just before I get to that question, I just want to add something to what Rob said, which I think was quite appropriate. Just 2 extra points, really. The first one of those is obviously updating your values with Centrelink. Have a look at how your actual Centrelink entitlements would be calculated anyway. So, if you're under the assets test and you're already getting a full pension, then there's no real need to go and change anything, because it's not going to give you more. So it's only where you're not receiving a full pension might you need to do this. And the other thing just to be aware of, the government has announced that from the 1st of May, the deeming rates that are used to calculate under an income test, if you're income tested, the deeming rates will be falling. So you do certainly want to make sure if your asset value has fallen, that you do update it with Centrelink so that they are using the lower amounts when they calculate deeming on a lower amount, which bring the 2 things together. If you're income tested, could help increase the rate of your pension. So there are just a couple of things that are coming up that I would say just bear in mind with that as well. But back to your question, Beck, has the horse bolted? Is it too late? Sort of what do we do now? Well, it's sort of the reverse, isn't it? Because we're sort of saying, is it too late to move to cash? Well, if you've moved to cash, should you be moving back into the markets? And again, if I use what we've seen over the last couple of days, there's been some quite considerable increases in the markets generally and in some specific stocks. Now, of course, we never know what the right time is in the market. So saying do it today is not necessarily the right thing to do. But the caution I would add to you is that if you're sitting in cash, you are missing out on any opportunity for growth, which means as you start to draw down your pension, it's, your super balance is going to run out sooner because you haven't got the growth to help offset it and make it last for longer. You don't necessarily have to go all in, in one go if you want to go back in as well. You can use, there's a concept called dollar cost averaging, but basically what we're talking about is just reinvesting back into the market over a period of time really will help smooth it out. So you're getting a little bit of potential upside, but if things go backwards again, not all of your savings are exposed at that one point. So just think about the timing of when you would actually do it and how much you do each time.
Seems like the perfect time to bring in our chief economist, Besa. How connected is what's happening with the stock markets right now really connected with what's going on in the Australian economic outlook, or is it more global?
It is connected to what's happening at home, but certainly it is being driven by global factors. And those same global factors is what's impacting the Australian economy. So if we think about the share market investors have been pricing in a lot of bad news. They've been pricing in the fact that the daily rate of infections continues to ramp up around the world outside of China. That's impacting uncertainty, it's impacting business confidence, it's impacting consumer confidence, and that's having a knock-on impact to economic activity. So it's hurting the operating environment of businesses, which is really why we've seen the stimulus packages from all policymakers around the world, but including in Australia, really focus on trying to support otherwise viable businesses survive during this crisis period until we get to the economic recovery. So if you like, creating a bridge between now and the economic recovery, and the economic recovery will come when infections peak and subside, so that those businesses can survive and limit the job losses. So that news is being priced into share markets. Now, what we've seen over last week and early this week is a more upbeat tone among investors, and that's being reflected in the share market. In fact, our share market's up again today. It was up yesterday and it was up the day before, and it was modestly higher over last week. And that's reflecting not only the third stimulus package from the federal government announced on Monday, which was its largest ever and included that wage subsidy, but also the fact that last week the US government announced a massive stimulus package of $2 trillion. And so we're seeing that flow through into markets. But what I would just add, Rebecca, is that the one ongoing theme over the next few weeks and few months, until we see around the world infections peak and subside, is really going to be volatility. Volatility is going to be the dominant theme. So even though we've seen a bit more of an upbeat tone come through in the last week and a bit, that may not necessarily persist.
What's your view on the medium-term Australian economy here? I can't wait to hear.
Well, containing the virus involves locking down societies and having social distancing and restrictions. So that impacts economic activity. We are seeing spending outside of essential services fall quite sharply. We're seeing business investment fall quite sharply. And so as a result, we are seeing a recession unfold in Australia. And the last time we had a recession was in 1991. So we've had an incredibly good run of almost 30 years, but that run is now coming to an end. And a recession is defined as 2 consecutive quarters or more of a contraction in economic activity. So we are forecasting a contraction in this quarter that just passed yesterday, the March quarter. We're forecasting a very large contraction in activity in the June quarter, another contraction in the September quarter, and then a recovery coming through in the December quarter. Our forecasts are premised on the notion that infections will peak before the end of June. So the longer the peak gets pushed out, and obviously we're not experts in health, so there is a risk that it could be pushed out, then the longer it will take for the economy to recover. Now, recessions always come hand in hand with higher unemployment. So we are already learning of companies that have laid off workers. But Monday's announcement from the federal government around the job keeper payment is a game changer that will certainly help limit the increase in job losses. But we are still expecting the unemployment rate nationally to rise from 5.1%, where it currently stands, to 9% before the end of June. Now, because the crisis is still evolving and there's a lot we still don't know about COVID-19, it means that our forecasts have more variability attached to them than normal. So it's our job to forecast, and certainly that's what we see as the best, as the scenario at the moment. But just bear in mind, the crisis is still unfolding and those forecasts have more variability than normal attached to them.
Did the stimulus that the government brought in the last week make a big difference to your forecasts and the outlook?
It certainly did. Prior to Monday's third and largest stimulus package, we were forecasting a much higher rate in the unemployment rate in terms of where it would peak this year. But subsequently, as a result of that stimulus package, we do think that there will be considerable jobs that will be saved as a result, because businesses and even the self-employed, which are eligible for these payments, will hold on to workers, or even if they're stood down temporarily, they'll still be receiving a wage. So that has brought down, in our opinion, the peak in the unemployment rate.
Oh, well, that is good news. Rob, I've got one for you. We've had a lot of questions about the worry that people put money in a bank and that the situations of banks can change over these types of crises. How safe is money in a bank account or term deposit?
Thanks, Beck. I'm going to say at the moment, probably the first thing is Australia has amongst the world's most safest banks. So I'm going to say just on that basis, your money is safe with them. But we also have a backup from the government called the Financial Claims Scheme. Now, the Financial Claims Scheme is like a guarantee. So if you've got, you can claim up to $250,000 per account holder, per financial institution. So all your accounts at the one financial institution all get added together, and you're guaranteed to get back $250,000 of that money. If it happens that maybe you've got money in deposit accounts in a joint name, then that is split in two. So it's per joint holder. So if I've got $300,000 in an account with my wife, then $150,000 of that adds up to my $250,000. $150 adds up onto her $250,000 with any other accounts that we may have. So for most people, that's going to really mean that your money is safe and you don't need to worry about it.
Yeah, right. I mean, that's something that we get asked all the time, and particularly before the stimulus was coming out, there was lots of doomsday stories and you know, the world was going to end. I think people might be relaxing a bit now. Do you feel that way?
I think we're getting on top of this, but for people, it really is saying our banks are strong and we do have this guarantee. So your money is safe. Well, you don't need to worry about it.
Cashless payments in this environment, and we talked about this in our last webinar, which Rob was on board with as well. I got turned away from buying a loaf of bread the other day with my $10 note. So it became really, really evident to me that I wasn't prepared. And for many of us, yes, I have an ATM card. Yes, I have a mobile phone, but I haven't hooked up my mobile phone to tap, and I haven't hooked up my iWatch, and I really am pretty lazy about it. Yeah. But they're becoming more important now because of the infectious nature of notes.
Yeah. And I must admit, the World Health Organization says you're not going to get the virus anymore from notes than you're touching any other items out there, right? I think where businesses are coming from is they have a lot of notes coming through from a lot of people. So they're just being overly cautious. And I started noticing this 2 weeks ago of businesses not accepting cash and having to get out my card and tap to do things. The great thing is about tapping, I've been tapping since the technology came out. I find it really simple to use. You can use a debit card, credit card. You may have it loaded on a phone that may be able to use it. We have a thing called Payware where you get a little chip that you put in a bracelet or something you wear on you that you can tap. So there's a lot of different ways to do those contactless payments out there. Some people are a little bit concerned because maybe there's some security risk. With the tap side of it, you can only tap for up to $100. So it's only $100 per transaction. So yes, people can do lots and lots of $100 transactions, but usually that really limits how much they can do. If it's over $100, you will have to key in your PIN number to get that transaction to work. But again, it's very simple. How people go about getting it, I'm gathering is your next question, Beck.
It is my next question. You got me.
Sorry to jump in there. Right? But how you go about getting it is, as I said, you need a debit card and an account, of course, that that's linked to, that has the chip technology in it, or a credit card. So I'm going to say for a lot of people, debit cards are just as good, although if it's got debit and credit on it, it generally put it through your credit card when you tap those things on. How you go about getting them, go on to your bank's online service. There's tips there on how to actually apply for that. You may have to go onto your online service. I know at Westpac we've got videos on how to actually do these things. We've got step-by-step instructions to help anybody with it. Now you also can, of course, ring our call center or go into a branch, but at the moment we've still got plenty of people on the line, so you may have to wait some time if you do it in those environments.
Look, and that's important to say. I think I've heard from different people that in foreign countries, some of the branches have had to shut down. There's always that worry that I think there's something like 1 or 2 million people who still rely on passbooks in Australia. Many of those are over 60. So whilst the people on Zoom here today might not be those people, I think we would ask everybody out there who's digitally capable to try and help their friends and family to get online during this period. I guess it sometimes feels like I'm beating a drum that might be well heard by the Zoom and Facebook Live community, but the feedback out of our last webinar was so many people spoke to their 80-year-old parents or went, oh, wow, mum's still using a passbook, I'm going to have to pay her bills if this accelerates. So it is that discussion that's very, very important to have. So when branches shut down, what happens and what do people need to do now? What's the quick checklist?
First one, Beck, I'm hoping branches aren't going to shut down. They're considered an essential service, and they should be an essential service. We consider them an essential service for people because being able to access your money is really important. But you're absolutely right, things may change, or we may actually have staffing or health issues in particular branches that we can't open. So those things can happen. You know, at Westpac, we've got 120,000 passbook holders still coming in and using their passbook, and good on them. If that's the way they want to do the banking, that's fabulous. But you're absolutely right. At this time, if a branch isn't available for them, they're not going to be able to access their cash. So it's a good idea, just as a bit of a safety precaution, if we can get them into online banking and opening up an online account. So because we're talking about over 60s here, we do have a concession card holders Westpac Choice account, which has no fees on it, to make it very simple for people. We also have a 55 plus retired account for other people. Again, there's no ongoing fees. There's a couple of little fees there for overseas transactions and things. Plus, if you've got sizable deposits, there is some interest on those accounts as well. So there's a couple of options for people to get on. So if I was a passbook holder, I would say open one of these accounts. You can do it online, in the branch, with customer care, that type of thing, and put enough money in there for, to last you a couple of months, so that if you do need it, you can access it. And the great beauty of that, well, actually, I'll go back to, most of the people we're talking to have probably already got online banking. And you're absolutely right. It's probably their parents.
It's their parents.
That don't have it.
The people that they sit with at dinner or now can't sit at dinner. But really, we're all checking in on our friends by phone now. So, part of this is...
Part of this is...
get online.
It's just the way it is now. And we've got to help them. So first step, be patient, right? We're talking with people who weren't born in that digital age, right? If you think about it, the personal computer didn't come onto the scene until the early 1980s. They've been around a lot longer than that. So they don't have, a lot of us have been brought up with how computers work and the logic behind them. They haven't. So the first thing is always be patient with them. That's really important. Next, probably talk a little bit about the benefits that if they can get onto online banking, they will get a debit card with their account. They can get a credit card if they apply and are approved for that, but they can get a debit card, which means they can get their cash out, not just at the branch, but at an automatic telly machine. With the debit card, they can do the tap and go. We were talking about the contactless payments, that type of thing. So they will get that with their account. But also when they go online, they can check their account balances at any time. They can check their transactions, basically for most transactions, they'll be there on that day, if not the day after. So they can check, when their pension payments go in on that day, not having to wait for their bank statement to come out.
And that brings you're right. That brings me to spending more generally. Really, Scott Morrison has been talking about the fact that he's fighting two crises right now, a health crisis and an economic crisis. And he wants to keep everybody in jobs and for them to keep their spending up as normal. So you've got to be able to access your pension. You've got to be able to get it out and use it still in the next phase. But with jobs being lost and super balances shrinking, I want to ask Besa, is the natural instinct to tighten our belts something that we need to balance as a nation and still feel like we should spend?
Well, certainly there is that balance. It's inevitable that we cannot prevent this recession from happening, simply because if you want to see a peak in the virus and the number of infections to subside, which will ultimately give us more confidence to spend money, until we get that, the natural inclination is for us to be more cautious around our household budgets in this sort of environment, particularly when there is heightened uncertainty, when we don't know when will the actual virus peak or not. Whilst there is that massive stimulus package that was announced on Monday, which does provide wage subsidies, it's still a case that many Australians will feel insecure around their job over the next period ahead. So I think in that sort of environment, it's quite natural to be cautious and to look at your household budgets. And I think that's the appropriate thing to be doing in this sort of environment. Yes, balance it against spending. So try not to, get overwhelmed by the very negative news stories. But ultimately, a recession is unavoidable. Spending is going to drop sharply. The government cannot avoid it. And as I mentioned earlier, it's really about these stimulus measures from the Reserve Bank and the federal government and the banking industry, really trying to help otherwise viable businesses survive, to limit job losses and create that bridge between now and the economic recovery. Because to get that peak in the virus, to see infections subside, it means that we do have to shut down societies, and that does have a negative economic impact.
Yeah, it's awful to watch the small businesses that we used to order food at and from having so much trouble. I know my parents even went out to buy takeout the other night and were telling me about it. I'm like, you should stay home. And they said, no, we have to support our local businesses as well. And it's that real juggle. I've got to keep running with the questions because there's so many sitting in backlog. I could talk for hours. So Rob, we back to asking your bank for help. We've heard a lot about renters who've been told that there will be special arrangements that let them take a break from paying rent. But there's a lot of retirees on the other side of that who rely on rent payments from an investment property. and that provides their retirement income. What assistance should their bank offer them if they're still having to make mortgage payments on that property while the tenants are unable to pay them?
Okay. So Becca, from a renter's perspective, if they've still got a mortgage and their income's now not coming in because they've given their tenants time not to pay, then they can come to the bank and apply to have their repayments deferred, basically for the next 3 months, and we'll look at it for another 3 months after that. Anybody who has a loss of income, so I know we're talking about the over 60s, but it's basically anybody that has a loss of income can apply to us to have that put in place. I should say though that it's a deferment of your payments. You will still have to pay back your loan and the interest will continue to accrue. Your repayments may go up at the end of that period to fit in all your repayments by the end of your term. So you need to be aware that that's happening, but it's really to help out that cash flow crisis from that point of view.
Oh, it's great to hear that people can get help. Can they notify Centrelink that the loss of rent payments is a drop of income?
Yes.
Increase potentially?
Yes, they can notify Centrelink about that, but they may be in a position, because they do have property and it's rented property, that will be part of their asset. So they've had that asset test that they have to get through. So unless their asset value has dropped, they may not be able to get any more pension on that side. But it doesn't hurt to ask.
Yeah,
right?
I mean, that's what everybody's saying. Ask.
Ask. But as Bryan said, if you're already on the full pension, it's only for those on a part pension that really need to ask that question and update their details.
Yeah, great. I've got a few questions for Bryan now, all around property. People are really, really interested in property. This is the generation of property, obviously. Readers have two main questions. When your super balance is falling because you're invested in equities and markets are going down, is it a good idea to continue salary sacrificing into super? Or would you be better off paying the mortgage on your home?
Look, it's a very good question. So I'm going to talk really generally here because you might get slightly different answers for different people, and I would encourage everyone who's obviously watching to get their own personal advice around it. But I guess there's a couple of things that you need to think about. So the first one really about, is it worth continuing to salary sacrifice into super? I think the first question has to be, do you have enough income? Because if you don't have enough income, then I'd think, yes, straight away you should probably stop your salary sacrifice, and so you've got more income coming in. So that's not about what do I do with that extra money. That's about, do I need it or not? Then if you don't need that extra money, so if salary sacrificing was an option, again, you've got to think about, well, where is it going to be better placed? So if we're going to continue to salary sacrifice into super, the first thing you think about, or you need to know, is when you put money into super, how long does it take before it actually gets invested into the market? Because it doesn't necessarily happen the same day that the money is hit your super account. So it might be a period of time. So getting that money into super, we might be in a better position when you start to look reinvesting it back into the share market. So you need to think about that as part of the option. Obviously, yes, markets have gone down, but as we've sort of talked about, there's recent times there've actually been some upward trend as well. So just be careful about thinking, is it always going to keep going down, down, down? Because if that's the thought and I'm not going to put it in, then you probably miss out on some of that upside. Think about what the return is that you might be getting on it. So sure, it might not be as high as we've had in the past, but also what's the interest rate you're paying on the mortgage on your home? Because are you better off to get a return that's a couple of percent that still might be slightly higher than what the interest is on your loan? And therefore you're actually better off having the money invested. But all these things, we don't really know the answer. So it really is about balancing everything up to try and work out what the right answer is in your own situation.
Yeah, and with interest rates as low as ever, it's a different discussion this week to 4 weeks ago, isn't it?
Yeah, exactly.
And then, Bryan, I have to ask the other big question that comes up all the time in discussions is, what about drawing down a lump sum from your super to pay off a chunk of your mortgage or some debts in case you lose your job and have trouble making your repayments at their current level? And we've just dropped, we've got him back. Excellent.
Yeah.
Tell me about, and I hope you caught that, paying off your mortgage with a chunk of your super or a chunk of debts. Is that a good idea?
Oh, again, it's the same sort of thing, because if you're going to take a lump sum out of your super, then it means you're going to be probably selling down some of the investments that are in there to do it. So it's sort of like we talked about earlier, moving to cash. It's the same sort of scenario that you have to think about, is it the right thing to do? Having said that, if you do choose to take some money out and put it against your super balance, against your mortgage, then obviously think about it. It might help because, yes, number one, it might reduce the level of principal and therefore reduce the amount of interest that you have to pay into the future. But also, when you think it's the right time that, maybe I should have been back in the share market, is there potentially the option to draw back? If you're paying ahead, could you redraw some of that money to get it back into the super environment at a different point in time? So again, there's always different things to be thinking about in this aspect.
It's a really interesting time. Most of us wish we didn't have to live through it, but it's an interesting time indeed. Still on property, because everybody loves property. Rob, I've got one for you. What about mortgage holidays? You talked a little bit about the payment delays. Plenty of viewers have pointed out that it's not like their borrowing is wiped out by the banks, and you've just pointed it out too. They'll just have a larger sum to repay when they're in a better financial position and they resume. So would they be better off, if they can afford to do so, to switch to interest-only payments instead of taking mortgage repayment holidays?
Okay, so Beck, I think this is going to depend on people's personal situations. It depends on whether they can continue to make mortgage payments or continue to make interest payments. Have they lost income? Where are they at the particular point in time? But you're absolutely right. I would advise anybody at any time, if they have the capacity to do it, it's probably very good to put it against your mortgage. At this time, if they've got an offset account, so that's a transaction account that offsets against their mortgage and reduces the interest on the mortgage, put the money in the offset account. That way you get the reduction in interest, but you also get the benefit of being able to draw that money out at any time when you need it. So that can work really well as a strategy for people at this time.
That's awesome. We've dropped Bryan for a minute, so hopefully he'll pop back in, and I'm going to ask Besa another question on the property market. What's your view on the property market, Besa? Is it right to think that it's currently frozen because auctions and open houses are not on? It's probably too soon for price data. So what do you expect property prices to do, and for how long?
Sure. So auctions are still happening, just online. I understand are also still happening, but they're private inspections. But obviously, it is a change and a disruption from what prevailed previously. As many participants online will be aware, since the middle of last year, we have seen an upturn in dwelling prices, and that has been fueled by low interest rates, as well as a relaxation of some of those macro prudential measures and underlying demand. But what we do know is in recent weeks, auction rates, which are a very good forward-looking indicator for prices, have consistently fallen. And in fact, the last data that I saw had the weighted capital city average for Australia in the low 60s. That's still a reasonable rate, but it's certainly well down on where it was before, and the trend is headed lower. So that is telling us that the signal is for downward pressure on prices likely to emerge over the next period ahead. And certainly we would expect less transactions to be going through. There has been a rise in the number of withdrawals of homes from auctions. So that's consistent with lower transactions going through as well. Building approvals, so actually constructing dwellings. In terms of detached housing and low-rise buildings, so apartments of 4 stories or less, we had actually seen a little bit of a stabilisation prior to the outbreak of this crisis in Australia. Not for higher density apartments, but we would expect that stabilisation for detached housing and lower rise apartments now. And we'll likely see a further leg down. So really what we will see in the period ahead, I would expect, is some dampening on prices of property while the daily rate of new infections continues to rise, and we're in this period of uncertainty. Just to add, Rebecca, that there is an enormous amount of stimulus in the economy at the moment, and that does include a cash rate from the RBA of 0.25%. of which then variable mortgage rates are priced off with a margin, and fixed home loan rates are also incredibly low. Now, the RBA governor, when he cut the cash rate to that record low level and also launched quantitative easing, which involves buying bonds to target a 3-year government bond yield of 0.25%. In a Q&A session, he actually said that he expects the cash rate to remain low for some years. And he actually indicated probably at least 3 years. So what I would say is when the economic recovery comes, it will be coming with a period of low interest rates for a long time, or for an extended time. And that will then give momentum, I think, to the housing market once confidence returns.
This generation is one that absolutely loves the property market. So, I mean, it's overjoying to hear your view on that. I just know how many questions we get about a resurgence in property, and also about the fear of interest rates and inflation. There's a generation here that is over 60 that has a long memory of the pain of inflation and hyperinflation, and other generations simply don't remember it. I'm going to move on. Rob, I have some questions for you that are all about our end of life planning. It's a topic that, you know, we all sort of get the heebie-jeebies to discuss, but it's important right now to discuss. So when we talk about super, money in the bank, property, it all relates to our end of life planning. What's the minimum planning everybody should have done right now, Rob?
The minimum planning, Beck, and you're right, this is a hard one for people. People don't like to think about their end of life, but they really need to do. I'm going to actually start off as the minimum thing with your superannuation. Most or under your super, you can nominate who your super goes to in the event that you do pass away. So you should check if you've put that nomination in, because if you haven't, it just goes into your general estate. And if you want it to go to a particular person, nominate who that person's going to be. And that nomination means your super won't go into your estate. It'll go to that person. Which comes to the next bit of, you should have a will in place. And what's a will? Will is just about saying, what do I want to happen to my estate? Who do I want it to go to after I pass away? If you don't have a will in place, then that will be determined who that money goes to by the various states. So the states will appoint a trustee to your estate. Then they will, according to the laws in that particular state, and they are slightly different in each of the states of Australia, they will determine who your estate goes to, which may not reflect where you are with your relationships right now. So that's why a will is important, so that you get to say, or have a say in where does your money go to.
Yeah, no, look, I know my will's 10 years out of date. So, you know, the need to do them, and we're even going to be getting ourselves live for our community, an online will system in the next couple of days. I think I said that the other day and I nearly laughed. Yes. So, but we encourage you, if you haven't updated your will, it's something everybody should do right now. So, Bryan, the other big thing to remember is that your will doesn't necessarily cover that super issue. Oh, and we've covered this question. So yeah, Rob's already jumped in and done the answer on this one. Before we start running through some viewer questions, there's a couple of questions that have been coming up pretty regularly from everybody. Rob, if someone's close to pension eligibility age, how much before that date should they apply for the pension? A couple of months, or do they have to wait till they've turned the pension age?
You don't have to wait till you turn the pension age. You can apply 13 weeks. So that's pretty much 3 months prior to your birthday. You should get on and apply straight away. Make sure, because there's a bit of paperwork and you have to find all of your assets and income and everything to put together. So better to get onto that early rather than leave it until that date, because you don't get your pension until all that paperwork has been completed and signed off at Centrelink.
And that's a very helpful answer, because I think everybody wants to know it's all done. Bryan, if you're working and can put off retirement and thus drawing down on your super for 6 months or a year, is that a good idea in the current environment? And what should somebody take into consideration before making these decisions?
Oh, look, I think certainly, you should. Simple comment probably right now is if you've still got a job and you can hold on to it for a period of time, you should. It gives you some certainty of your income that's going to be coming in. So absolutely encourage that. I think in this environment is a really important thing to do, because the longer you can put off drawing down your super, the longer it's going to last you into the future. Plus, if you're still working, you're still getting the 9.5% super guarantee coming in. You might be salary sacrificing and putting some more money in there. So I absolutely think this sort of time, the more you can delay either starting to draw down on your super or perhaps even reducing the amount that you're taking out of your super is an important thing to be considering, along with obviously how do you have your money invested.
The government's letting people withdraw $10,000 in emergency withdrawal rules that have been introduced to super, and to make a gift or loan to their adult kids. Is it a good idea or a bad one? We've got a lot of people who want to help their kids at this time.
Well, this is almost a bit of a loaded question, this one, because there's a couple of things to be thinking about here. I mean, obviously, it's a bit like drawing down to pay off, an extra bit on your home loan. So there's that first question about, is it right to take the money out? I think for a lot of people, the fact that, it's a benefit that they can now do is really important. Let's not forget that, if we've already retired, then we don't even need to worry about this $10,000 sort of dollar allowance from the government. We could have done it anyway because we've already got access to our own super. So it's obviously for those who didn't otherwise have the access. Is it worth doing it to make a gift or a loan to the kids? Well, absolutely. That's your own personal choice about, are you doing it for the right reasons? But remember, that's your retirement savings that you're not going to have. So if you're going to give it to the kids, you need to think about, well, what's my chances of getting it back if you need it back? Some people are lucky enough, they're going to be in a position where they can actually afford just to do it purely as a gift, and that's fine. The only other thing to be thinking about, though, in those sort of scenarios is if you're giving away some of your money, that can have an impact. You're okay if you only do $10,000, but if you're doing more than $30,000 over a 5-year period, or doing more than $10,000 in a particular year, that can have an impact on the amount of payments that you are getting from Centrelink, whether it be the age pension or other sorts of things. So they keep a close monitor on the gift side of things as well. So be really conscious of that.
I've got one for Besa now. What do we look out for next from the government and the Reserve Bank? More one-off cash boosts for pensioners, another interest rate cut. What comes next?
So the RBA has vowed that it feels that it's done enough for now, or at least that's what it said when it cut the cash rate to the record low and launched the quantitative easing program. But the RBA government that nothing off the table and they'll do whatever it takes. So economic activity does evolve in such a way, the crisis evolves in such a way that they feel need to do, then they will come out and do more. And that might be something that involves an expansion of the quantitative easing program. It might be an enhancement to their term funding facilities that they launched. And those term funding facilities are about enabling the banks to access cheaper funding from the RBA in order to provide more attractive lending rates to borrowers and their customers. In terms of the federal government, when Prime Minister Scott Morrison launched the second stimulus package on Sunday, the 22nd of March, he did say that he didn't expect that would be the end of the stimulus measures. And he's also previously flagged that we can expect disruption to the economy for at least another 6 months. So that might mean in that 6-month period that the infections peak, but we still might see disruption over that period. Now, he did go on and launch the third and largest stimulus package on Monday, which involved the wage subsidies, as we've spoken about. But on Sunday, there was also a flag that the federal government, along with the federal treasurer, along with the state treasurers of each of the state and territory governments, they were looking at rental abatement for tenants. So that's still to be finalised and also announced by the individual state and territory governments. So expect that something of that nature might be announced by the individual state and territory governments. But I think for now, there is considerable stimulus that's been announced, and until the situation warrants more stimulus, I don't think we're likely to see more stimulus in the very near term until the situation warrants it.
And there's certainly been a lot flowing through. Now we're up to the community questions. So I've got a nice list and we've only got 10 minutes to go. So I'm going to keep us all moving fairly quickly through these so that we can get through as many as possible. My first question is for Rob. With regard to the bank account government guarantee, because it's up to $250,000 per financial institution, should people with more than $250,000 in an account spread it across several banks? And if it's per institution, a bank's subsidiaries counted as separate institutions. For instance, would St. George, which is a subsidiary of Westpac, be considered a separate institution under the guarantee?
Thanks, Beck. I'm going to say subsidiaries of institutions are all considered the one institution, as I understand it, under the APRA rules. With regard to splitting your money between different institutions, in Australia, I've just got to reiterate this, we have amongst the safest banks in the world with regard to our prudential requirements. So it's pretty safe in whichever bank that you have your money in. Yes, if you want to be super conservative, you could split it around, but that just adds that complexity to where's my money, how am I handling it, what interest rates am I getting. It will get down to an individual consideration for each person.
And I've got an extended question on this. Does the guarantee extend to small family company deposits, such as term deposits that are in a company name, things like that?
I've actually, I believe it does, right? But I'd have to get back and check on that one for you.
Okay, we'll respond to the community a bit later on with some of the answers to the ones that are harder here, guys. I've got another question for Besa. Years ago, we experienced interest rates of anywhere from 12 to 16%. I remember my parents living through it, and I was only a teenager at the time. Could this happen again? And on the flip side, could we move to negative interest rates? I mean, we're stuck right in the middle of not knowing here.
Good question, Rebecca. Over the next few years, I would see the probability of interest rates being towards the double digits as extremely low. The cash rate at the moment sits at a record low of 0.25%, and the RBA governor has said that he expects it to remain at that level for some years. So we know that we are in for a period, an extended period of low interest rates. So getting to the double digits is a very low probability scenario. On top of that, we are seeing economic activity contract in Australia. So recession is unfolding. And when economic activity contracts, you need low interest rates in order to try and boost demand and boost prices. So it's not in that sort of environment that we would be seeing interest rate rises, and particularly interest rate rises towards the double digits. Now, before the outbreak of the virus, we had a situation in Australia where economic activity was growing, but at quite a subdued pace. It was well below potential. The unemployment rate was above the rate that's consistent with full employment, and the underlying inflation rate was running below the Reserve Bank's target band of 2 to 3%. So those three trends suggested that even in that sort of environment, the RBA would need to keep providing policy stimulus. Is negative interest rates likely in the period ahead? Well, I don't think in this sort of environment you can dismiss anything, given that it's a pandemic and given that we've never seen this before. It's very different to the global financial crisis, and it's very different to the sorts of factors that produced past recessions in Australia. However, the Reserve Bank has made it very clear in remarks over last year and into this year that it really sees negative interest rates as a last policy resort. It's not something that it's in its toolkit, but it's certainly probably going to be the last tool that's probably pulled out of the toolkit. So they'll only, I think, go towards negative interest rates if they absolutely need it and everything else doesn't work.
Oh, the words unprecedented just get used too much, don't they? Bryan, I've got one for you. If you change investment options within super, do you start accumulating returns or not on this exact day, or does it take super funds a few days or longer to enact your change?
Yeah, look, usually it's not instantaneous. Normally you're submitting a request and then the superannuation fund will act on it. But again, different superannuation funds will act on it within a different time period. So you need to check with your fund. But again, as soon as, these days it's not a lengthy process, particularly because most of these sort of requests are lodged electronically. It's not fill out a form, send it off, wait a week for it to get somewhere, for it then to get processed into a system and so on. So it's a lot quicker. But you do need to just check with your superannuation fund as to what that timing is. But again, it's sort of thing. If you're thinking about I want to change my investment option, then you're making a decision to do something. You sort of do it when it's right. Just make sure it's the right decision. And that's, again, I just encourage people to get personal advice about what it actually means for you, because what it means for you might be different to what it is the person you're sitting next to in the house next door, across the road, wherever they happen to be at this point in time.
I've got a curly one. The current environment has some viewers thinking about annuities rather than a super income stream. Can you give us a super quick overview on the pluses and minuses of a lifetime annuity?
Sure. So really quickly. So obviously with an annuity, what you're doing is you're giving up access to a lump sum of money in order to get an income stream. So with super, remember, you sort of get the best of both worlds, that you've got access to the lump sum if you need it, but in the meantime, it's going to pay you out as an income stream. With an annuity, you're making a choice. Normally what you'll find, though, is that the income stream that you'll get paid from that annuity is probably higher. And because you can get it for lifetime, it doesn't matter if your money runs out, you still get paid. So that's the benefit of it, but you just can't get access back to your capital. That's the sort of trade-off that you make. Now, we sort of talked about that, many years ago, interest rates were at a really high level. And annuities looked really good at that point in time. People were starting annuities when interest rates were in the double digits. And so they were getting significant payments. Obviously, with the lower interest rates today, the level of payment that you potentially get out of your annuity is going to be lower than what someone might have got in the past. So again, you just need to balance it up. But the big difference, you might get a higher income stream. You can get it for life rather than when your money runs out. But the trade-off is you don't have access to the capital.
Yeah, okay. Hang on. Now I'm unmuted. So, and the final one for Rob, if your asset and income changes and you update Centrelink via MyGov, does Centrelink backdate the pension to when your asset value or income dropped?
I believe not. So pretty much they start it from whenever you tell them. So the next payment after that.
Yeah, okay, so that makes sure everybody stay on the ball with your MyGov account. It is very, very important to keep updating with the changes in your asset values and your income. So I am going to throw to each of you for one final message to wrap up today. What is the one takeaway you'd like to leave with the thousands and thousands of over 60s of Australia? Rob, you first.
My takeaway is going to be the same as I did last Friday, to say, if you're not online or your parents aren't online, get online with your banking. It's going to, in the coming days and weeks and maybe months, it may be imperative that you're on there. So make sure it happens.
Besa.
I'm going to say that, first of all, please stay healthy. But second of all, I'm going to say to just bear in mind that all crises do pass. This virus will pass and economy will recover.
Wonderful. And Bryan?
So look, similar to Besa, it's, this is going to come to an end. So, if you're thinking about doing something now, my word of advice is don't overreact. Just sit back and think about it before you choose to go and do something, because you don't want to overreact and all of a sudden think, I shouldn't have done it. Just be comfortable with whatever decision it is that you're going to take.
Look, thank you guys. I just could not feel more blessed to be able to have your company today and to be able to bring what has been very, very sensible insight to our over 60 community. We really appreciate you taking the time. Take care, all of you, and safe at home. Everybody's working from home at the moment, all of these three included. and we really appreciate you. Thank you very much to everybody for coming along today. As I mentioned, Starts at 60 is adapting our services to support over 60s in these changing times, and we'll send out a survey after this event and would love your feedback on things that would help you in the period ahead. We're looking for ideas, so please hop on our Facebook page and email us at community@startsatsixty.com with your ideas. And remember, our meetups will be back as soon as we're all allowed out of the house again. We have more than 100 meetups on the first Tuesday of every month all around the country. So there's just the most amazing community engagement. And until then, we'll be having online events in coming weeks. And we want you to sign up at startsatsixty.com so that we can reach you with those events and you can know all about them. And they're on finance, health, lifestyle, all sorts of good fun. We'll even be having a pet show, I'm told, which could be pretty fun along the way. If you go to our site, you'll also be able to find the Starts at 60 Essentials program when you sign up, which is about helping you help yourself on this journey over the next couple of months as we're a little bit more housebound, quite restricted in what we can do. We're trying to make it everything as fun as possible. Thank you very much again to our incredible sponsors from Westpac. They are just a fantastic team with so much insight, and it's great to see you offering so much support during this time. I've been your host, Rebecca Wilson from Starts at 60. We're here to support you. Stay safe, stay strong, and we hope to see you all again soon.